When you're buying a real estate asset, it's important to use an entity to do so. And the main reason for that is asset protection. Another main reason to do so as well is also for your taxes too. So we'll walk through some of the reasons in more detail and explain why you want to do this throughout this section of the course. So you're buying a self-storage facility. If you put it in your own personal name, and let's say you have another job, now you've got this difficult situation of mixing all of the different income and expenses and profits of that entity, of that facility, your own income taxes as well. If you then want to bring in partners, it becomes very, very messy if everything's in your personal name. It becomes difficult to do so, to raise capital, to refinance, and lots of other things too. Also, let's say someone has an accident at the facility. If it's in your personal name, then they can go after all of your assets, not just the facility that the accident happened at too. So a big part of the reason of having that entity is for your own protection, for asset protection. It then also gives you different write-offs that you can do for taxes as well, and also allows you to bring on partners. And also when it comes to financing your property, there may be difficulties if everything is under your personal name. Also, if you plan on owning more than one facility and you plan on creating a brand, it's very difficult to do so if it's all owned by Mr. Bob. You kind of want to set up individual entities to own the assets, and you can have a holding company that owns all of those assets as well. That way you're creating separation of assets between yourself and the properties, separation of liability. It's also just better image for branding and for business. I mean, if you're working with brokers, if you're working with sellers, and everything's done in your personal name, you don't look like a company. It looks like it's just you doing things. You want to give the impression that you're an established professional team operating through a holding company or entity. So these are all different reasons for setting up an entity to own an asset. And what do we mean by entity? So you've heard of LLCs, limited liability companies. There's Incs, corporations. There's LPs, limited partnerships, and trusts. And depending on the specific situation, you might go for one over another, but the typical way that people do this is they have a holding company, which is either a corporation or a limited liability company, and then each individual asset is then owned by a limited liability company with all of the property's expenses, assets, that means cash, the revenue that's coming in from rental income is held by that LLC. Then that LLC can make distributions to you for cash flow, and it makes things a lot simpler, a lot cleaner, and also a lot safer from a liability protection. Trusts is a little bit more complicated and usually something that most people do not do, but is a valid way of protecting yourself and your assets too and creating separation. But if you're running your business day to day, most likely you're on a holding company and then individual LLCs underneath. So forming the entity. Usually, it's going to cost anywhere from a couple of $100 to about $1,000 to form a limited liability company for a new entity. It depends on which state you do it in, and I would recommend that you speak to your CPA and about which state, from a tax purpose, may affect you the most or the least. But also, there's asset protection. So certain states are more favorable for asset protection than others. A Nevada LLC is very popular. Wyoming LLC is also very popular because of the privacy and the asset protection that these states afford through the LLC entity. And so common names tend to be things like A and B investments, A and B interests, A and B associates, A and B company, A and B holdings, A and B storage, A and B and partners, A and B real estate. So you can put in your own name that you're interested in there. You don't have to use one of these words at the end of your name. It can just be whatever name you decide to be. For example, Silver Eagle LLC or Silver Eagle Real Estate or Silver Eagle Holdings. You just need to be a little bit creative with the name so it stands out. And for your holding company, you can use a more general name. If you are going to brand your self-storage units, then you may want to think about using the word self-storage inside the name somehow too, but that can be done separately to your holding company. You don't have to have every name matching up. it's good actually to have a separate holding company with a different name, because that gives you, again, separation, and the holding company can then own the different storages that you buy over time too. The rules for liability protection, of course, this varies slightly by state, so you do need to check with whoever's helping you do the formation. But the key points are that you mustn't commingle assets, no commingling of assets. You need to make sure that all of the different documents are done correctly. For example, corporate minutes, making sure that you file any documentation on time. You need to make sure that each entity's documents are correctly signed off on time. And also, you can't have the appearance of using the entity just for asset protection. There has to be a reason why you're separating it, and a valid reason is to have, the self-storage, income, expenses, profit and loss in the LLC running as its own business, because a self-storage facility is essentially a business. But to have that separation, to have that asset protection, you do need to make sure that you're following the rules, you're doing all of the documentation, and there are lots and lots of accounting companies out there that charge a reasonable fee to do all the filing, to make sure that all your documentation is up to date, and so you have the correct entity in place for that as well. It's very different when you are raising funds for an investment. Of course, you can't just have a simple operating agreement and a simple LLC, but we'll cover that in a separate section of this course. But when you're raising funds, you do need to consider the entity structure. It may be different from your typical structure, and there may be different shareholder types for outside investors, for the sponsor. It gets a little bit more complicated, and the operating agreement of that gets a little bit more complicated. But from a simple standpoint, if it's just you, or you have a holding company and then you're investing in individual properties, having an LLC or another entity protect it is a very wise choice. It doesn't cost much, and it can save you potentially all of your assets if something was to go wrong or there was a liability. Usually insurance also covers some of that, but again, this is just in case for the long term. Just as you buy life insurance, etc., you're not expecting to die next week. You're doing this entity and structure just as an added safety net in case something does happen.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.